We're taking a look at the currency market now with Nomvuyo Guma, Macroeconomic Strategist over at Standard Bank. Thanks so much, Nomvuyo, for joining us this morning. Well, let's get straight into it because we had a good Italian bond auction yesterday and then a surprising improvement in U.S. consumer sentiment, allowing the dollar rand to drop all the way to the low 730s in yesterday's session. But erratic trade is what it was labeled at yesterday, or pretty much more of the same, one would assume, anticipated for today, where it's all revolving still around all that emanates out of the Eurozone territories.
Morning, Alishia. Yes, you're absolutely right. The rand, as always, remains adrift on global currents, and yesterday they seem to be largely positive based on the same factors that you mentioned, the positive Italian bond auction, also some impressive figures out of the US and some optimism there that there's been a recovery in consumer spending. There's been a very positive Thanksgiving holiday spending period, and it looks like consumer confidence numbers bounced back quite convincingly. So the rand did manage to rally yesterday, and in the short term we think that this improved optimism could stay a little bit longer, so we'd expect to see some further rand strength in the short term.
Interesting that you say that, because looking at the graph on screen, 845 is where we're at this morning, so extreme weakness having filtered through already. What kind of trading range is it possible to even peg out a trading range for the day and the day ahead, and what's left of the week as well?
It would be quite difficult, Alishia. As you mentioned, trade has been quite volatile, and as you say, the rand has already begun to weaken substantially this morning. Wouldn't see it perhaps going much further than, say, the 850 level, but again, trade remains extremely volatile, and the current market conditions do make it quite difficult to give an exact range, but somewhere between sort of 830 and 850, we'd expect the rand to remain within that range in the short term.
Where are your confidence levels sitting right now, Nomvuyo, when it comes to the European situation? Because many saying that, the market's been burnt so many times before, hoping that Europe will come up with a solution, that they're just not, sitting with confidence levels where they need to be at this stage.
Absolutely, but this has been a theme that we've been talking to for quite some time, that actually the problems in the Eurozone are structural in nature, and leaders in the region seem to be quite slow to wake up to this reality. And so all the solutions that they have been proposing have tended to be short-term, stopgap measures, very reactionary, as opposed to looking for one final solution that would bring the whole crisis to a close. So of course we're going to have these waxes and wanes in terms of optimism. Every time there's a new measure announced, changes to the EFSF, then you see a brief surge in optimism that then quickly fades away once people realize that the crisis continues to unfold. So we're not very confident of a resolution in the Eurozone this year. We still see things weakening, getting much worse in the area. We think that Europe is headed for a recession as well. So certainly not very confident as far as our view.
In terms of the economic data calendar, today we're anticipating Eurozone November CPI numbers and then also October's unemployment rate. Your general forecasts in those territories?
Our forecasts are pretty much in line with consensus, but I do think that at the moment those figures aren't probably going to be the key focus. Looking at what the ECB has been doing, although they do continue to talk about inflation, we think that the recession risks in that area are still quite significant and mounting. So in fact, our view is that they should be cutting rates as we speak. So I don't know that the data would be as much of a market-moving event today as it would under different circumstances.
One would assume then, with that being the case, that South Africa's trade data would also be of little significance, as we saw that GDP number yesterday, assume little market reaction, despite the fact that it came in well below expectations.
Yes, absolutely. That was also a bit of an anomaly. I mean, the rand was weakening in the morning. We had much weaker than expected credit numbers, and it did then continue to weaken into the afternoon after the GDP data was released, but then pulled back quite sharply once that optimism started to filter into the market. So one can never discount the influence of global developments on the rand, but other things being equal, we do see that this afternoon's trade is going to be a major risk event for the rand. We think that with the rand having depreciated sharply from August, there should be another trade surplus recorded for October, but the market consensus is for a deficit, and of course with the numbers being so volatile, it makes that also especially hard to predict. But certainly if it does come in being a sizable deficit, you could see that additional weakness then filtering into the currency.